Welcome to another explainer. So, check this out. Urban Edge property stock is up a really impressive 16.1% this year. That is a serious move for a real estate investment trust, and it kind of begs the question, what exactly is going right over there? Well, today, we are going to find out. We're slicing open their newly released Q1 2026 earnings report to cut through all the dense financial data and see exactly how their dividend-paying engine actually ticks.
All right, here is our roadmap for today. We're going to hit the dividend appeal, look at Q1 by the numbers, step inside the actual operations, scope out their future fuel, which is the leasing pipeline, and finally, do a quick stress test on their balance sheet and outlook. Let's get right into it.
Part 1. The dividend appeal. Basically, what is in it for us? Look, when you're putting your money into brick-and-mortar retail centers, you aren't just crossing your fingers for the stock price to go up. You want that cash flow, right? You want your cut of the rent. And the sheer momentum behind Urban Edge's payout right now is pretty incredible. Zacks Equity Research notes they're handing out a dividend of 21 cents a share, giving us a really solid 3.77% yield. But here's the kicker. It's the growth. Their current annualized dividend of 84 cents is actually up 10.5% from last year. And over the last 5 years, they've hiked this thing 4 times for an average annual increase of over 11%. That is the kind of consistent, compounding cash flow we absolutely love to see.
But hey, a juicy dividend doesn't mean much if it's going to vanish tomorrow. And that brings us to a massive metric, a 58% payout ratio. What does that actually mean for you? Well, it means Urban Edge is only using 58% of its trailing 12-month earnings to pay us. They aren't scraping the bottom of the barrel just to hand you a check. They have a massive 42% safety cushion to protect that dividend and reinvest in the business, even if the broader economy hits a nasty speed bump.
So the yield is great, the growth is there, and the safety cushion is super thick. But what is actually powering this whole thing? Where's all this raw cash coming from day to day?
That takes us to Part 2, Q1 by the numbers. Let's examine the engine.
Now, before we pop the hood and look at the actual data, we kind of need to clear up some real estate jargon. In a normal business, we usually look at net income. But in real estate, buildings technically depreciate on paper, which drags net income down artificially. But come on, a well-maintained shopping plaza doesn't lose value like a used car, right? That's why we use funds from operations, or FFO. FFO adds back that fake paper depreciation. You can think of it as the true cash-generating heartbeat of a real estate company.
And wow, look at how strong that heartbeat is right now. In Q1 of 2025, FFL per diluted share was 35 cents. Fast forward to Q1 2026, bam, it jumped all the way to 42 cents. That is a gigantic year-over-year leap. According to management, this surge is straight up driven by rent kicking in on new leases, higher net recovery revenue, and lower interest and debt expenses. The engine isn't just running, folks, it's accelerating.
All right, Part 3, inside the operations. Let's translate this real estate into real numbers.
Let's bring this down to earth and bridge the gap between abstract financial data and the physical stores you probably drive past every single day. Urban Edge owns 74 properties heavily concentrated in that really affluent Washington, D.C. to Boston corridor. And look who is cutting them checks. The TJX companies, so Marshalls and TJ Maxx, Kohl's and Best Buy. Absolute retail heavyweights with incredibly resilient footprints. But here's the jaw-dropper. In Q1, when they signed new leases on empty spaces, they locked in an average cash spread of 51.6%, meaning new tenants are happily paying over 50% more in cash rent than the old guys did. No joke. Demand for their space is absolutely scorching. To measure how much juice they're actually squeezing from these physical buildings, we look at NOI, or net operating income. Simply put, this is the raw profit of the property itself. It's just the revenue from rent minus the basic cost to keep the lights on, like property taxes and maintenance. It strips out all the corporate overhead so we can see how the dirt and bricks are truly performing. And you know what? The bricks are doing fantastic. Same property NOI grew by 2.4% compared to last year. That tells us their existing shopping centers are organically getting more profitable over time. And keep in mind that 2.4% doesn't even factor in their external growth, like their recent $54.3 million acquisition of the Village at Bridgewater Commons in New Jersey, which they scooped up at a super attractive 7.7% cap rate.
Moving on to Part 4, Future Fuel. Let's check out the leasing pipeline.
So the golden question is, can they keep this up? To figure out the future of that dividend, we have to look at their leasing pipeline, which perfectly illustrates their future fuel. Get this, Urban Edge has $21.7 million in future annual gross rent from leases that are fully signed, completely locked in, but the stores haven't even opened for business yet.
That is roughly 7% of their current annualized NOI just sitting there, waiting in the wings to activate. It's guaranteed money on deck.
Let's map out when that cash actually hits the bank account. About $3.3 million of it is expected to drop in the remainder of 2026. Then, as properties finish getting redeveloped and tenants build out their spaces, it scales up massively in 2027, 2028, and 2029 to hit that full $21.7 million mark. For a long-term investor, this is a dream. It gives you incredible visibility and stability. It's practically baked-in growth.
Which brings us to our final section, Part 5, Balance Sheet and Outlook. Let's test their structural integrity.
Listen, a company can have the best tenants on earth paying top dollar, but if they are drowning in toxic debt, the dividend is toast. Fortunately, Urban Edge's balance sheet is built like a literal fortress. They're sitting on $968 million in total liquidity ready to go. Their net debt to total market cap is just 37.3%, which is very conservative. But here is the absolute best part, especially in today's economic climate. Their entire $1.68 billion mortgage portfolio is either fixed rate or hedged. Interest rates could spike tomorrow and they wouldn't even blink. They are perfectly insulated while other real estate operators are sweating bullets.
Because that foundation is so rock solid, and because they totally crushed it in Q1, management officially upgraded their outlook. They raised their full-year 2026 earnings guidance across the board, bumping up estimates for net income, FFO, and adjusted FFO. Let me tell you, when management raises guidance this early in the year, it is a massive signal that they are deeply confident in the health of their portfolio.
So let's tie this all together. You've got a real estate portfolio that is 96.4% leased, a massive $21.7 million revenue pipeline completely locked and loaded, nearly $1 billion in liquidity, and a super safe payout ratio. Honestly, the real question now isn't whether they can maintain their dividend. The question is, with all that cash, what massive acquisition are they going to make next to fuel that 10.5% dividend growth engine even further? Definitely keep your eyes on this REIT because they are clearly on the move. Thank you so much for hanging out and learning with me today, and I'll catch you in the next explainer.